Hi, I'm Andrew. I'm a professional risk manager, and today I want to talk about a concept called hedging. First off, for those unfamiliar with the term, hedging is the act of attempting to isolate and remove or amplify some aspect of or some component of the returns of your portfolio. So, for example, your common long equity has a few different things that would contribute to its risk. There is some amount of risk coming just from the market. That is your beta risk, your market risk. There is some component that may be contributed, depending on what kind of equity it is, on some commodity prices, oil prices, gold. Could have some knock-on effects in interest rates, bonds. It could have some knock-on effects just from the specific risk of that company, the idiosyncratic risk of a specific entity that you are buying. So through various derivatives, more sophisticated investment vehicles like a hedge fund, like some mutual funds, would be able to isolate bits of that return and either remove it or hedge it away or replace it with something else. The concept of hedging it away would be to say, I like the specific risk of this individual company, but I don't want to be exposed to the broader market risk that it's a part of, or even necessarily to the sector that it's a part of. So I will do something, I will go short some other security or set of securities and stay long in this equity in order to limit my exposure to the market or sector that I may not like as much. Sometimes it'll be, say, there's a characteristic of one stock versus another that you like or don't like. An example of that, of this kind of share class arbitrage, would be to say, I like Google A-class shares with voting rights. I think they are more valuable than the Google C-class shares with no voting rights. So I will go long GOOGL and I'll go short GOOG, or vice versa, to express my opinion about this stock. Now, the next question that might come up is, okay, Andrew, I am a long-only equity investor. I am a person trading on my own account, or not even necessarily full-time. I don't know that I either understand these kinds of derivatives that you would use to hedge, or I don't know that I'm comfortable with it. I mean, there is a classic saying in finance of, with a long position, there's infinite possible return, capped possible loss. You cannot lose more money than you invested in the security. On a short, it's reversed. The most you could possibly gain on a security on a short is the dollar value of it today, because the best case scenario is the stock you are shorting goes to zero. The worst case scenario, the stock goes to infinity. Your losses are unbound, your gains are bound. Me personally, that is why I don't invest in shorts. There are types of trades that you could do to mitigate that. A common way that you would think of trading short versus long would be something called a pairs trade, where, say, I like Chevron and I dislike Exxon. I think by going long Chevron and short Exxon, I am short the specific risks of Exxon that I don't like and long the specific risks of Exxon that I do like, and the two kind of cancel each other out with respect to exposure to oil, the market, the broader energy sector in the US. Now, as a long-only investor, do I still have the ability to hedge out risk in my portfolio? It might surprise you, but the answer there actually is yes. You can hedge out some amount of risk using only long positions. Now, the way that you would do that, or the way that I would argue would be most cost-effective to do that today, without going into more exotic instruments, staying long only, equity shares or ETF shares only, is that there is a class of ETFs available called inverse ETFs. There are also leveraged ETFs that you could buy. There's a company called Direction, Direxion, that offers a number of shares that they call their bull and bear shares, that they have the ability to follow the market levered up to 3 times, or go effectively short the market levered up to 3 times by actively buying equity shares. When I say levered, that is to say they are borrowing money in order to invest more than the AUM of this ETF. They are putting in more money than their net asset values. They are doing that by borrowing and buying shares. The borrowing cost adds a little bit of overhead and increases the fees of the ETF, but theoretically, a 3x levered bull share in the S&P 500 would pay you 3% return for every 1% realized in the S&P. Now, how do you use these things to hedge your portfolio? So let's say I have a portfolio consisting of your FANG stocks, that is Facebook, Apple, Amazon, Netflix, Google. These are all US technology companies. I like the characteristics of these companies a lot, much more than the characteristics of the broader US information technology sector. So I can say, I want the specific risks of these 5 stocks, but I want to hedge out the risk of US technology by buying those 5 stocks and then buying some proportional amount of an inverse ETF invested in the US tech sector. Similarly, you can buy, right now, I personally am invested, at least in a minor hedge, in 3 times levered bear shares against the S&P 500, because my portfolio is so severely exposed to S&P. I had comparatively little cash on the sidelines, and by doing this, it allowed me to hedge out more market risk in days like today than I otherwise could with my available cash. The downside to all of these things is if the market skyrockets up, my investment goes to 0. But any good hedge, you are effectively splitting your trade thesis into 2 parts. There's the part I think will outperform the market. There's the part that I think will gain me some sort of alpha above the market. There's the part that I think will likely lose money because I am just buying it to kind of mitigate some amount of losses or gains in my shares that I'm buying. So, broadly speaking, your hedge instruments, you kind of expect to be losers. And your equities that you're investing in, you're kind of expect to be winners. So you are, to a certain extent, capping how much you could possibly gain on the right market conditions. In the case where, say, Apple is on fire and so is the broader market, you are removing all of that gain from the market from your gains out of Apple. An example where that might have been bad would have been the year 2019, where the S&P ran up some 30 plus percentage points over the year. You would have been dragging the gain of any individual stock you owned down by 30 percentage points by investing in an inverse S&P ETF. That said, in a scenario like today where the S&P is dropping precipitously, you are increasing the performance of your portfolio because as you're losing on your individual stock, you are gaining on your inverse exposure to the S&P, on your effective short exposure to the S&P, and providing your stock loses less than the S&P, you are actually net gaining money. Now, the next thought in this is, okay, I think I understand what it is to hedge. I am not comfortable with some of the risks in my portfolio. I am not comfortable with my exposure to developed market equities at this point. It's kind of a complicated question because with a hedge, you can hedge out some or all, of the risk. So you can decide you only want, a 50% hedged portfolio versus 100% hedged. I want to get still 15% of that 30+% S&P gain if it goes up. But if S&P goes down, I want to cut my losses in half. So I'll only hedge 50%. Now, the other interesting thing that these inverse ETFs allow you to do is to put in what I'll call a synthetic short. That is, you can, through long-only purchases, be effectively short a single name. Now, how would that be implemented? So, let's say I really don't like 3M. I think that they are, the biggest dog of the Dow, so to speak. So I want to short 3M. But again, I have a restriction. I really don't want to go short the stock individually. I'm not comfortable with that unlimited loss. I want to have specific circuit breakers on my potential losses here. So what I could do is buy an inverse ETF that exposes me inversely to the Dow Jones. I use the Dow as the example here because the Dow is smaller. There's only 30 stocks in it, so it might be more cost effective to structure a trade like this. If you're doing this with an S&P or a Russell index where there's 500 plus stocks, this might not be so cost effective, and it might be kind of difficult to structurally design. But with the Dow, you have a couple of simplistic things here. One, they have the easiest weighting scheme of any of the indexes to implement. The Dow is effectively one share of each company. It is price weighted. So effectively 1 unit of Dow is the equivalent of 1 share of each of the 30 companies. So I can say, I'm going to buy some inverse Dow ETF, and then I'm going to buy shares of every component of the Dow. I will go long shares of every component of the Dow except 3M. So I will own in total 30 positions, 29 long equities, 1 short index. The long equities and short index should be structured that, the 29 securities I have, I will buy 1 share of each or thereabouts. I'll buy them in equal proportion. I will sum the dollar exposure of all of the shares that I have plus the shares of 3M that I should have bought if I was replicating the Dow, and then put that amount of money in my short ETF. Then I will be exposed to just short 3M. You could do kinds of things like this with a combination of equities and options. There are concepts of synthetic call, synthetic puts, synthetic index. Why I say synthetic is because there's the trade that you want to do, and then there's a trade that you're implementing. And the trade that you're implementing does not explicitly do any of the steps of where you want to go. So if I want to implement a synthetic put, I will buy a combination of equity, treasury, calls, whatever. What I will not be buying is an actual put. So I hope this was a little bit enlightening. It helps you kind of understand how to limit your risks in a choppy market like this. We're still in a position where we don't know what tomorrow is going to bring. And we're waiting for the market to kind of calm down and the world to kind of get a little bit saner in light of all of the virus news. But I hope you can sleep a little bit better with a thought on how to potentially hedge your portfolio, how to reduce some of your downside risks, while I still would hold out the advice that any of the longs that you have today, you probably should keep in place, because by closing out of longs today, all you're really doing is locking in those losses. One thing that's extremely hard to do, especially in markets like this, is to time the market. And the old saying that the most important thing is time in the market, not timing the market, is more true now than ever. So to the extent that you have cash available, you might want to use that to put in some effective inverse ETF positions to hedge out some of your risk. And with that, I say happy investing to anybody out there that is looking for a platform to invest in. I would recommend using, to the extent that you're comfortable with something a little bit more advanced and that you're looking for something mobile first, I would recommend using Webull. I'll have a link below in the description. I'd also might recommend for people with larger positions, I personally use behind me TD Ameritrade. Fidelity is also fantastic. Charles Schwab is fantastic. The only one I would reiterate my explicit steering away from is Robinhood, given their technical difficulties in past weeks. I was a Robinhood investor for the last 5 years. I pulled all shares out of Robinhood and would recommend that you do the same. That said, happy investing, everybody. Stay safe out there, and till next time.